This video will cover investment policy statements. An investment policy statement's a living document that summarizes one's lifelong goals and develops a map to reach those goals. We're talking financial goals. Now, before we go further, let's look at what a typical person's life cycle looks like in terms of net worth. This is helpful for you to figure out where you fit in, and if you end up managing other people's money, you need to know where they fit into this graph here. So we have net worth on the y-axis and we have age on the x-axis. And you can see early on, not unexpected, that net worth, which is assets minus liabilities, is pretty low early on. And so there's what's called an accumulation phase of assets. And so you need to look long term for even out to retirement, kids' college needs, your house and your car you're thinking about. Now, to me, this graph's a little optimistic in that it seems like it's showing a positive net worth for people under 25. I would say in some cases it's actually negative at 25. I'm pretty sure I was negative back then. You know, because you're going to have some college debt, you may have some debt, and so your net worth, probably assets minus your liabilities, it's probably going to be negative. Not unusual. But in any case, it's going to ramp up eventually over time, and it'll peak out, as you can see, around 60-ish. And so, you know, between your accumulation phase and what's called the spending phase and gifting phase as you approach retirement, in the middle there's a consolidation phase. You're still saving for retirement, and you're saving for vacations and kids' needs. Hopefully you have a house by then, most likely. And then as you get further along, you're thinking about estate planning and giving money away long term. And then, you know, what are you going to do for retirement? Spending needs for retirement. So that's the typical life cycle in terms of net worth. Now let's go further here. The ultimate goal and the immediate goal of an investment policy statement is to derive an asset allocation that's consistent with your client's needs. An example of asset allocation is 10% cash or money market, 40% stocks, 30% bonds, commodities 10%, real estate 10%. Now in terms of tradable assets, often the commodities is zero. The real estate is zero, although people may own houses, and if you look at the broad view, they'll have a substantial amount of money tied up in real estate for their house. Now, if you're looking at just retirement money and funding retirement money, you're narrowing the scope of it a little bit more. Then you're looking at stocks and bonds mainly, and a little bit of money market. So you're always going to need some money market stuff. You're going to need some liquidity in case there's a problem. Coronavirus hits. You're going to need some cash on the side. You never know when things like that happen. The Great Recession hits. People become unemployed. Yeah, the money market should have some money in it. Now, there's also stock and bond compositions. And so at your age, the typical student's age in the low 20s, or even up in the early 30s, it should, in my opinion, be almost all stock. Even at myself, I mean, I'm in my 50s, and I'm almost all stock. I have money market, obviously, because I need liquidity. I might need liquidity, but I'm almost all stocks. Okay, so it's not unusual, by the way, to have a 40-60 composition for middle-aged people, 40% bonds, 60% stocks, but it all depends on the risk aversion of your client and how much liquidity they need, as I'll get to in a few minutes. So after the asset allocation strategy has been implemented and time goes by, a review of the investment policy statement and its objectives need to be checked. So I'm just giving you an overview at this point of how it works. Here is an outline of the steps that should be done in terms of planning steps, execution steps, and feedback loops. So first, let's look at some planning steps. You're going to determine and document the investors or the clients or your client's expectations. This is a planning step. So you're going to need to sit down with your client. They're going to have to fill out a whole bunch of forms. You're going to need to know about their tolerance for risk and their background and how much wealth they have, where it's tied up, and so on. That's a planning step. Then you're going to need to determine the investor's risk and return objectives and constraints. and you're going to need to document them. And that's really important. Those first 2 steps, document. You got to document it. Now, the third step is determine an asset allocation. So based on the first 2 steps, with that documentation, you're going to learn about the client's risk and return objectives, constraints, and their background. You're going to develop an asset allocation. It's really important, as I'll talk about a little later. Then you're going to execute an asset allocation strategy. It's an execution step. Then you're going to measure and evaluate a portfolio performance over time and relative to your objectives. And that's a feedback step. Then you'll monitor the client's objectives and capital market conditions to see how the market's doing. That's what that means. Capital market means the stock and bond market and how it's doing. And you may have to rebalance the portfolio over time. And the reason for that is if you have most of your, if you put 50% of your money in stocks and 50% in bonds, just as an example, well, in 20 years, you're going to have probably 75% in stocks and 25% in bonds. And so you might want to rebalance. That's what rebalancing is all about. Now, in terms of what you need to do with StockTrack, I'll talk about that towards the end. But look, in the first investment policy statement or first report you need for StockTrack, you're going to determine and document your expectations for the market. You're going to evaluate and think about your risk and return objectives and your constraints. And then you're going to determine an asset allocation. And you know what? You're going to execute it in StockTrack. And then over the semester, and you're going to execute it early in the semester. And then over the semester, you're going to measure and evaluate your portfolio performance and rebalance as necessary. Okay, so let's look at in detail at these planning steps and these steps we just looked at. So first off, determine and document the investor's expectations for the economy and financial markets. That's really important. You may have to guide your client in this area because your client may have no clue. They may be really well educated. They may be doctors. They may be lawyers, but they don't know anything about the financial markets. And so if you told them, well, 4% is a good return, they might believe you. I wouldn't look at 4% as being a good return. The average market return for stocks is ballpark 10, 11, 12%. Now, reasonable expectations are important. So your client needs to have reasonable expectations, and you may have to counsel them to make sure that they have expectations that are in the ballpark. So they shouldn't have expectations of a 50% return. It's kind of crazy. So you need to counsel them that that's probably not likely. Would be nice, but not likely. Now, let's look at this planning step here. There's various ways of doing planning. You can do what's called a top-down approach, and then you can do what's called a bottom-up approach. And let me give you just a word on bottom-up. Bottom-up means you're really not interested in how your portfolio looks like when you're done. You just pick stocks that you think are going to be really good, and you don't care about the portfolio aspects. Top-down approach is completely opposite. Your goal is to make sure that you have an asset allocation, and you're focusing on your portfolio first, and then you find stocks that fit into that big picture of your portfolio. So let's look at it. So you start really wide. You start worldwide, for example, with the top-down approach, and then you move to the specific. So you might forecast growth for all countries, select the most attractive countries, and, so maybe it's the U.S. because you like their growth prospects. Then within each country, determine which asset classes are acceptable. So maybe it's U.S. and then it's stocks and bonds, for example. Maybe real estate's out because you think it's overpriced. And then within each class, determine what categories are acceptable. So every asset class has subcategories. And remember what asset classes are. They have distinct risk and return characteristics. So within each asset class, there's subclasses. So if you look at U.S. stocks, you could fine-tune that down to U.S. growth stocks, U.S. value stocks, U.S. small cap, mid cap, and large cap, and then large cap value, large cap growth, and it just goes on. So you can think about it from that perspective. And bonds are the same way. But although there's different terms for them, you don't have value bonds. You have intermediate bonds, you have short-term bonds, and so on. Then, going even more specific, like a microscope, you're going closer and closer towards focusing on a particular stock. You're going to determine acceptable sectors. So maybe you'll look at the financial sector, and then maybe you'll go even more narrow and look at money center banks, and then eventually you're going to find a particular stock that you want, a particular bank. So, by the way, don't even think about doing the top-down approach in your stock track paper, your investment policy statement that's due at the beginning of the semester. And the reason for that is, look, by the time you investigated which countries were acceptable to invest in, and the asset classes within each country, in the industry within each asset class, and the subclasses, and all the work you get down to a particular stock, by the time you did that, all the information you had would be so stale it wouldn't be worth it. What most financial planners do is they subscribe to newsletters that do that for them, that summarize where the good investing activity is around the world, and what industries and what sectors. And a lot of big companies have offices in those countries. So they write newsletters and they sell the newsletters to financial planners. So financial planners have access to that information and they rely on it, and it saves them a ton of work. You could do that for your stock track report. Rely on somebody else's analysis, but just document and reference it. Okay, let's look at step 2. Determine the client's risk and return objectives. Okay, risk objectives. Differentiate between the client's ability and their willingness to take risk. Those two things may not be the same, and you're going to have to tease out the client's ability and their willingness to take risk. And let me define that a little better here. The ability to take risk is a function of the client's required spending needs. Required spending needs depend on the time horizon when they're going to need the cash, their long-term wealth targets, their stage of life, where are they in that net worth process, and where are they in their careers, and then their financial strength. You need to focus on what's required spending needs, which is deeply connected to the time horizon that the person has to invest in before they start using their money. The higher the required spending needs relative to existing wealth, the less risk the client can afford to take. That's an important point. The higher the required spending needs relative to existing wealth, then the less risk the client can afford to take. The shorter your time horizon, the less risk a client can take, in other words. Now, here's a word of advice. So clients are often in a jam by the time they seek investment advisors. And what you find out is their spending needs, their current wealth, their long-term goals are completely out of whack. They haven't met their goals. They haven't even documented any goals. They never really had any goals. And so, when they suddenly wake up and realize, hey, I should have some goals, and they think about what their goals ought to be, they're nowhere near it. And what they may be doing is they may be trying to ask you as a financial advisor to hit a home run for them. Because, man, they just don't have, they know they're not going to be able to get to their financial goals unless they somehow strike it rich. And they're going to look to you to do that. And that's very, very hard, because if it was easy, everybody would be rich. So usually the way out of these jams is to take a conservative approach. And by the way, I often see this even in stock track over the years. Students, their portfolio's in the trash. It's in the dumps. It's $900,000. They lost $100,000. They're coming to me in my office. How do I get out of this jam? How do I move up in the rankings? How do I get back over $1 million? Hey, if I knew that, I wouldn't be here. I'd be, on some island drinking a pina colada. So my point is, it's not easy to do that. It's not easy to hit home runs. People are going to look for any way out of the situation. Okay, let's talk about willingness to take risk. Willingness to take risk has to do with the client's intrinsic risk aversion. So if you look in your text, and many investment texts, and it's all over the web, there's all sorts of questionnaires about how you might view risk. Can you sleep if you had a certain type of investment? Do you often gamble? Are you a speculator? How do you handle risk? And so you need to give your client one of those forms and figure out and tease out what their risk tolerance is. It's very important. Very often clients are too conservative and not willing to take much risk. But if they have a long horizon, you're in your 20s and 30s and 40s, you've got plenty of time. And so you shouldn't be too conservative. You should be mainly in stocks. But keep in mind, you don't want to ignore the client's concern for risk. And so if their willingness and ability don't match in terms of risk, their views on risk, counsel them. You're going to have to advise them and try to come to a middle ground on it. Okay. Now, what's interesting, and we discussed throughout the course, is that clients can view risk differently, and they can set their objectives accordingly. Risk can be viewed in terms of absolute or relative basis. And so what do I mean by absolute? Well, they could say, I want a return of 15% per year, or I want a standard deviation of no more than 14%, or a loss of no more than 10% in a given year. Now, not too many people are going to talk in terms of standard deviations. They'll tell you they want a certain return. They don't want to lose X amount of money or X percent in a given year, and that's how they're measuring risk. Now, a relative risk objective would be where the client does not want to take more risk than, say, the S&P 500 or the Dow, or they don't want to lose more than 5% relative to the S&P or the Dow. So that would be relative. And those are easy to view and easy to handle because they're easy to handle and easy to operationalize because you always see what the Dow is doing and you kind of know how your portfolio is doing if you're trying to mimic the S&P 500. Now, let's look at return objectives. Return objectives fall into two categories. It's desired and it's required categories. Desired or return objectives are based on the client's subjective expectations, but required returns are more important, and they're based on the client's spending needs, existing wealth, and long-term wealth needs. Return objectives must be consistent with the client's risk objectives. So if the client has a really high return objective, well, maybe that's reasonable given their age and the investments you're going to go into. But if you expect a high return, that upward line for the security market line and the capital asset pricing model, the more risk you take, the higher your expected return. So flip that around. If you have a high expected return, you're going to have to take a lot of risk. Now, desired return objectives and required return objectives must be consistent, else counseling is in order. There are other dimensions to returns. There's lots of dimensions, but you can look at real or nominal. Most people think in terms of nominal, but security analysts sometimes do a lot of analysis in real. I prefer nominal. It's very hard to predict inflation, and so you kind of just build it into your returns instead of trying to keep backing it out. There's also absolute and relative return objectives. Now, one of the most important concepts within the return objective is the concept of total return. Total return. We studied it in Chapter 1, which is composed of a capital gain component and an income or a cash flow component. It's important to know this concept because many retired investors, they have large portfolios with the expectations of generating cash flow to meet their living standards. So they want that portfolio to remain just the right size to give them just enough cash flow to live out their life in retirement. You're going to be walking a tightrope, but nevertheless, that's the goal. So implicit in using cash flow only and not capital gains from the portfolio for normal living expenses is that the portfolio will appreciate to keep the cash flow growing at least at the rate of inflation. So in other words, you got to spend some of the portfolio down using the cash flow, dividends, interest income generated from the portfolio. But you want that portfolio to be growing a bit because over time, that portfolio needs to grow a bit to keep up with inflation. Other return objectives, there could be capital preservation, where the ultimate desire over everything is to minimize the loss of principal. There's also capital appreciation, where your goal is kind of like home runs. You don't care about dividends, you don't care about interest income. You just want to invest in growth stocks, for example, would be the way to go there. Then there's current income, where you focus in on cash flow rather than capital gains. Okay, let's look at constraints. And by the way, we're still in step 2. There are 5 main constraints. Time horizon, which is probably the most important. It drives the ability to take risk. And by the way, you can have multiple time horizons depending on your stage of life. And so if you're young right now, before you own a house, before you're married, then that's one stage. Then you're going to get married, You have a family, that could be another stage. Where you buy a house in there is another stage. Kids' college could be another stage. And then after that, towards retirement. So that would be you. That would be your clients in possible various stages. And they have various time horizons that change. There's also liquidity needs. And the more liquidity that an individual needs, the less return they're generally going to get, because it turns out in finance that liquidity reduces risk. And so you have lower risk, then you're going to have a lower expected return. There's tax issues. This course doesn't really deal with taxes, so if you took a tax course, it would kind of help you here. Tax rates may cause investors to shift assets around to take advantage of lower tax rates, like tax-exempt municipal bonds, for example. And then how to shift money between 401s and 403s and IRAs and so on and so forth. That would be a tax course. There's also legal and regulatory issues, trust accounts, endowments, pensions, estate planning and all that. That's not this course either. Those are very specific, detailed courses. There's also, within the constraints, unique circumstances. And the classic example of a unique circumstance would be you're counseling somebody, you're managing their portfolio, and they have, a couple $100,000 in stocks and bonds, and they have like 10 million in a company that they run. And so almost all their wealth is tied up in their particular company. Now, if that company goes under, all of their wealth basically disintegrates and evaporates. And so that's where you're going to need to counsel and advise these people that somehow they need to reduce that company investment they have. They're going to need some diversification. And that's what we mean by unique circumstances. It's not that easy if you're the owner of a company. Who's going to take over for it? You're going to want to keep it. The client's going to want to keep it, but that's where you're going to need to counsel a client, that type of risk. Now, asset allocation, let's look at that, is mainly concerned with what asset classes to consider for investment, what policy weights to assign each class. So 40% bonds, 60% stock. That's what we mean by asset class weights. And then allocation ranges. So, for example, if you set up let's just make it simple. You set up a portfolio, 50% bonds, 50% stock. It's not going to remain 50% stock, 50% bonds the second you're done. It's going to change as soon as stock prices change, stock market drops, and bonds stay relatively constant. Well, the next day you're probably going to have slightly more weight in bonds. So you might want to have ranges. So you might want to say, well, I want to keep 45 to 55% in bonds and 45 to 55% in stocks. So it allows you some wiggle room. Now, what's really important about asset allocation is it determines 85 to 95% of your investment returns over the long run, just on how much money you allocate to those asset classes, provided you properly diversify within each asset class. That's really important. That's big. So that's why asset allocation is huge. But once you determine how much weight goes in each asset class, you need to reasonably diversify within each asset class. So you reasonably diversify within stocks. So you might want to go small cap, mid cap, large cap, some growth, some value, some international, and so on. Now here is an example of investment returns by asset class over the past 30 years. And so we have U.S. stocks overall 11%, large cap about the same amount, mid cap a little bit more because they take more risk. Usually they're more risky companies, and then small cap. And so what we mean by large cap is large company, large capitalization, price times quantity of shares. And so look at small caps, a little lower, a little depressed compared to micro. Now micro caps are 13%. They did pretty well over the past 30 years. These are just arithmetic averages, by the way. And then we have global stocks, excluding U.S., kind of small at 5.71. We have short-term bonds. Obviously, you expect that to be low. That's like treasury bills. Then you have intermediate, a little bit more, long-term bonds, since they're riskier. Long-term bonds, 8.61. REITs, which are real estate investment trusts, pretty high. Look at that. Gold, not so hot. TIPS, Treasury Inflation Protected Securities, we'll cover later on in the course. Not that great, 5.2 3%. But remember, they're bonds, so it's not that bad. And commodities, the all-time loser here, and that lost 6.18%. And then inflation was a little over, nearly 2.5% per year on average. And right now it's hovering around 2%. Now, feedback steps. Monitor the portfolio, and if you have poor results relative to your objectives, and that's where it's important to have those objectives documented, then if you have poor results, you'll see them right away, and then you can make changes. And over time, a client's financial situation is going to change. Their estates are going to change. There could be, they could end up getting large amounts of money or losing large amounts of money. They have changes in their family situation. All of that's important. So you need to monitor the portfolio with respect to those changes that the client is going through in their life. Now, this course is not a personal finance course. So a personal finance course would go into not just managing. They're not really into managing portfolios. That's kind of a given. But what they do is they look at the overall broad picture of somebody's financial situation. And what's really important is insurance. Because if you're not properly insured, all these like 30 slides I just went through, throw them out the door, out the window, because they're useless. Because if you spend all your time and you develop the greatest investment policy statement and you have the greatest portfolio and it's doing great, if you're not insured for health, basic major medical and things, you get into an accident, you get into a health problem, and your portfolio is going to disappear because your portfolio is just going to get drained paying bills. So it's really important to have insurance to back it up. So it's not just health insurance, it's income insurance, short-term disability, long-term disability, property and liability like auto, home, and commercial property if you have commercial property. Now, what is expected of you in this class? Well, you're going to need to develop and write an investment policy statement for a client that leads to an investment allocation strategy. That's due like 3 or 4 weeks from the beginning of the semester. You're going to need to execute that strategy in StockTrack, and so that you tell me you're going to have 25% invested in corporate bonds. I'm going to look for $250,000 in corporate bonds in your portfolio. I have access to your portfolios in StockTrack. I can see everything that's going on in there. So like I said, if you tell me 25% corporate bonds, I'm going to look in there to see if you have $250,000 in corporate bonds. You're going to do this early in the semester. So you have a long time to monitor it. And that's the next point. You're going to monitor yourself. You're going to monitor the portfolio. You're going to monitor the financial markets and your strategy and evaluate it over time and make adjustments as needed. And then at the end of the semester, you're going to write a report. And that'll present your experiences. And that'll be due at the end of the semester. So that's it for investment policy statements.